You are young, maybe just graduated. You want to invest, but after looking at your bank account, you think, man, I'm broke. You keep waiting for that day when you finally have money to invest. That delay is the most expensive mistake of your life. Time is more expensive than money. What if I told you you don't need a lump sum? You just need a habit. $50 a week. That is the price of one dinner out in the weekend. By the end of this video, I will show you, even if you start from zero, the magic of compounding will blow your mind. We will simulate investing $50 a week in both VOO and QQQ and see how our portfolio numbers will look like in the future. First, you need to know what you are buying. Starting with VOO. This isn't just a fund, this is the market. It tracks the S&P 500 index, which represents the 500 largest, most dominant companies in the United States. But don't mistake size for safety. It has a strict filter. To get into the S&P 500, a company must be profitable. A committee decides who stays and who goes. It's basically asking, is this company essential to the American economy? What about its holdings? You are looking at 504 companies. It is the definition of diversification. The top 10 make up about 30% of the fund. You get everything here. Technology, healthcare, financials. You own the system. Top 10 includes NVIDIA, Apple, Microsoft, Amazon, and Google. Let's look at its DNA. Inception, 2010. Morningstar rating, 4 stars. Expense ratio, 0.03%. Dividend yield, 1.11%. 10 years dividend per share CAGR, 6.04%. 10 years price return CAGR, 13.97%. Dividend frequency, quarterly. Now, next up, QQQ, the innovator. It tracks the Nasdaq 100 index. Don't mistake it for just tech. It also has a specific filter. It selects the 100 largest non-financial companies on the Nasdaq exchange. It strips away the banks and insurance companies to focus purely on growth and innovation. It's basically asking, is this company building the modern world? And I think you already guessed its holdings. You are looking at 102 companies. It is much more concentrated than VOO. The top 10 make up 48% of the entire fund. You get the heavy hitters here: artificial intelligence, software, and semiconductors. You own the growth engine. Top 10 includes NVIDIA, Apple, and Microsoft. What about its numbers? Inception, 1999. Morningstar rating, 5 stars. Expense ratio, 0.18%. Dividend yield, 0.46%. 10 years dividend per share CAGR, 9.73%. 10 years price return CAGR, 20.11%. Dividend frequency, quarterly. Okay, can we just buy both? Let's check the overlap. Look at the Venn diagram. The overlap by holdings is 88 companies, but the overlap by weight is a massive 50%. That means half of QQQ is already inside VOO. The giant tech stocks, NVIDIA, Apple, Microsoft, and Amazon, drive both funds. So if you own both, you are taking the S&P 500 and doubling down on the tech sector. Now, time to check the historical performance. We pulled the total return data since 2010, which is the inception date of VOO. Remember, total return means dividends are reinvested and included. The gap is staggering. VOO delivered a phenomenal 736% return. If you bought the broad market, you won big. But what about QQQ? It delivered 1,423%. It literally doubled the return of the global market. Why? Because the last 15 years were the golden age of tech, mobile, cloud, and AI. QQQ captures that pure growth. VOO captures the growth, but it is diluted by slower sectors like banks and energy. Time to ask TipRank's top analysts about the next 12 months. VOO. The rating is a moderate buy, with a very strong upside of around 19%. And when it comes to QQQ, the rating shifts to a strong buy, with about 21% upside. So the pros are betting on a rising tide. They expect both the S&P and the Nasdaq to rip higher next year. But what about the next 20 years? We need the simulation engine for these numbers. By the way, we'll be honored to have you as a subscriber. Okay, let's start the clock. You are investing just $50 a week. First, VOO. After 20 years of discipline, your small weekly deposits have grown into around $265,000. It is a solid nest egg. But when do you cross the finish line? To be a millionaire, you have to wait until year 30. That is when the balance finally breaks the $1 million mark. Now, let's switch lanes to QQQ. The difference is immediate. At the 20-year mark, your balance sits at around $537,000. You effectively doubled the result of the S&P 500. And the millionaire line? You cross it around year 25. That means QQQ buys you the financial freedom almost 5 years earlier. So, which path should you take? If you choose VOO, you own the entire economy, not just tech. It guarantees you participate in the US growth story, no matter which sector leads. And if you can handle the volatility, QQQ is the wealth accelerator. It gets you to the first million faster. And if you pick this option, my personal advice is to buy QQQM instead. It is the exact same fund, but with a cheaper expense ratio. It saves you money over the long run. Now, your turn. What if you can invest $100 or $500? You can use the same simulation tool we showed in this video to run your own numbers. Grab it at the link below. Thank you for watching.